Something strange just happened on Wall Street. In the middle of fear, confusion, and distorted data, a quiet signal may have flashed. The bottom is already behind us. Tom Lee believes the chaos is hiding a deeper truth. And if you're paying attention, you'll see the setup unfolding before the rest of the world catches on.
The stock market is clearly trying to figure out the path of the economy going forward, because I think it's well socialized that economic data for the next 3 quarters is going to be polluted by not only the tariffs, but some of the bullwhip effects and the distortions that have been introduced.
For the next 3 quarters?
Yes.
9 more months of a lack of clarity?
Yes, because I think at the core, I think the stock market's trying to figure out, is this a dip in noisiness, but we exit 2026 in better shape? If that's the case, then equities would have already made their lows at 48.35 on April 7th, because that was sheer panic and dislocation. But of course, if we don't get trade visibility, and so 2026 looks like we're dragging for another 2 or 3 quarters into 2026, then of course the stock market is going to have problems.
That was Tom Lee, one of Wall Street's most trusted and surprisingly optimistic voices, delivering a message that's easy to miss unless you're really listening. Behind his calm delivery was a quiet warning and a loud opportunity. According to Tom, what we're seeing in the markets right now isn't the beginning of a collapse. It's a mirage, a distorted reflection caused by a whirlwind of tariffs, supply chain kinks, and data that's been thrown off course by front-loaded demand. You'll see the setup unfolding before the rest of the world catches on. So what looks like weakness may just be noise. And if that's true, then April 7th, when the S&P 500 dipped to 4,835 in what felt like a freefall, could go down in history as the turning point. That moment of panic might actually mark the bottom, but here's where it gets interesting. Tom Lee believes that fog in the market doesn't mean danger, it means opportunity. Because when visibility is low, the bold get moving, especially when the smallest signal, like a shift in tariffs or a cooling of global tensions, can trigger an explosive rally. So what's the smart move now? Retreat or prepare? Let's explore 3 companies that Tom and many in the smart money crowd believe have already hit bottom and are now quietly setting up for their next big breakout. First up is the undisputed juggernaut at the center of the AI universe, NVIDIA, ticker symbol NVDA. After a blockbuster earnings report and a $5.5 billion impairment linked to U.S. export restrictions, panic swept through the market. Investors bailed, sentiment flipped. But peel back the headlines and look deeper, and you'll find a very different story. Because while the market flinched, NVIDIA's fundamentals never did. Its data center division is now the company's growth engine, and it's firing on all cylinders. Between early 2024 and 2025, NVIDIA's revenue exploded by 114%. But that's not even the wild part. Operating profits soared 147% year over year, from $32.9 billion to a jaw-dropping $81.4 billion. That's not a blip, that's dominance. Interesting fact, NVIDIA's Blackwell GB200 chips are currently the only chips optimized to handle the most demanding AI workloads, and they're on pace to scale into millions of units next year. Yes, sales in China have dropped, from 18% to 13% in just a year, but the US and Western markets are more than picking up the slack. Billions are being poured into AI infrastructure, and NVIDIA sits at the center of that universe. Even analysts once skeptical of NVIDIA's valuation now point to its forward PE of just 18 times 2026 earnings, a bargain for a company rewriting the rules of tech. So while others are running from the noise, NVIDIA may already be halfway through its next climb. By the way, if you're liking this so far, hit that like and subscribe button. It really supports my channel and helps us keep creating informative content like this. And if you're thinking long-term, gold could be a key part of your strategy. I've got a free guide on gold IRAs linked below. Hang tight, I'll explain why it's worth checking out at the end of this video. Now let's talk about a name that's been flying under the radar, but might just be building the most important pieces of AI that no one's talking about. That company is Broadcom, ticker AVGO. At first glance, Broadcom might look like another chipmaker, but zoom in and you'll find something much more strategic happening behind the scenes. This is a company that doesn't follow the AI trend, it powers it. After a nearly 40% correction from its 2024 highs, thanks to macro fears and tariff headwinds, Broadcom is looking more like a slingshot than a falling knife. Here's why. Broadcom's strength lies in its XPU chips. Custom-designed AI accelerators made specifically for hyperscale customers like Google, Meta, and ByteDance. These aren't generic processors, they're purpose-built for speed, scale, and efficiency. That means Broadcom isn't trying to out NVIDIA, it's building its own empire. Even more interesting, Broadcom already has 3 of these hyperscalers in production, with 4 more in the pipeline. That means its total addressable market could double in the next 18 to 24 months. AI-related revenue alone reached $4.1 billion in the first quarter of fiscal year 2025, with second quarter guidance already at $4.4 billion. That's a stunning 77% year-over-year jump. And here's a stat that might surprise you. Broadcom's networking solutions, used to connect massive AI clusters, made up 40% of that AI revenue. That's not just chips, that's the digital plumbing behind the entire AI boom. By 2027, Broadcom expects AI revenue to hit $20 billion annually. That's nearly half of its entire current business coming from one hyper-growth vertical. Add in the often overlooked VMware integration and the growing subscription software base, and you've got a company firing on multiple engines at once. The market may be sleeping on Broadcom, but it won't be for long. Let's round things out with the giant that powers almost every major AI success story on the planet. Taiwan Semiconductor Manufacturing Company, TSMC, ticker TSM. While the headlines focus on tariffs and tensions, the world's most important chip maker is quietly preparing for its next supercycle. TSMC is the hidden backbone of the AI revolution, because no matter which company you're excited about, whether it's NVIDIA, Apple, AMD, or even Tesla, TSMC is the one building the silicon that brings their vision to life. In the first quarter of 2025 alone, TSMC posted $25.5 billion in revenue, up 35% year-over-year. The company is extending its lead in advanced chip production, with cutting-edge 3nm and 2nm processes already in motion. And soon, the 1.4nm A14 node, a breakthrough that puts them years ahead of their competition. Here's an interesting fact. Apple's upcoming A20 chip will be made using TSMC's next-gen 2nm process. No other foundry can match that precision at scale. TSMC expects its AI-related revenue to double in 2025, with a 45% compound annual growth rate projected for the next 5 years. And it's not just about growth, it's about strength. TSMC has $81 billion in liquidity, software-like profit margins, and is investing heavily in US-based fabs to reduce geopolitical exposure. Yet despite this fortress-like positioning, TSMC trades below fair value. Analysts estimate its true worth between $212 and $250, and the company itself is forecasting over 20% annual growth through 2029. So what does this mean for investors? If Tom Lee's right, and the worst really is behind us, then names like TSMC aren't just a bet on recovery. They're the foundation for a future built on AI. So what do NVIDIA, Broadcom, and TSMC all have in common? They've taken the hit, held their ground, and now stand ready for what's next. In a market still wrapped in fog, these companies are the beacons quietly gathering strength. And if even a hint of policy clarity breaks through, these aren't just recovery plays, they could lead the charge in the next bull run. Don't just watch the rebound, be positioned for it, because by the time the noise clears, these names may already be miles ahead. The stock market's been jittery lately, especially with President Trump's new round of tariffs stirring up global trade tensions. And when uncertainty rises, history shows us where smart money tends to go: gold. Central banks' demand for it last year alone reached a record high, and spot gold just surged past $3,300 an ounce. And recently, it has surpassed the Mag 7 as the most crowded trade on Wall Street. If you're thinking about ways to take advantage of gold in your investments, I found a company that gives Americans a free guide on how to add real physical gold to their retirement portfolio in a way that's simple and secure. No sales pitch, no pressure, just honest, helpful information you can trust. Click the link in the description to get your copy now, because when the biggest financial institutions in the world are quietly stockpiling gold, it's not just a trend, it's a signal.